Hey everyone, welcome back to another episode of our economic analysis series. Today's topic is hot and timely, but it's also heavy, both literally and figuratively. Japan's Ministry of Finance is dropping a bombshell by setting an interest rate at 2% for calculating the nation's debt service costs in their fiscal plans for 2025. Now, while 2% may seem like just a number upon first glance, the implications behind the scenes are quite staggering, representing more than just a superficial financial tweak. This could be the signal of deeper and more distressful economic issues bubbling up to the surface, ones that could potentially drive Japan, already teetering on the edge, further into fiscal chaos. Now, if you smell something metaphorically burning, you're not wrong. We are looking today at a kettle that has been on slow fire, Japan's national debt. Many of you may already know that Japan has occasionally been called the world's biggest debtor, with debt levels that clock in at over 250% of GDP according to IMF data. Oof, that's a figure that would make any economist sweat. But first, let's break down what's going on beneath this 2% interest rate hike and why it matters for Japan's economic future, and for the rest of the world. If you've been paying attention, Japan's finance ministry set the accumulated interest rate for calculating debt servicing costs at 2%. This is a step up from last year's 1.9%. Now, why should anyone care? It's because Japan already has mind-numbing levels of debt. And for a country with debt at 250% of its GDP, even a seemingly small increase in interest rates drastically escalates the cost of servicing that massive debt. Japan spends more on debt servicing, i.e., paying off the interest on its loans, than many governments use for their education, defense, and social programs combined. As rates go up, it means that Japan's government must siphon off more financial resources toward debt payments, leaving less money for programs that could stimulate the real economy. In other words, paying your interest bill starts looking like the country's full-time job. But what's even more worrying is that these baby steps in interest rate increases could soon speed up, as Japan has effectively begun normalizing its monetary policy after years upon years, or decades, really, of sticking to a low/negative interest rate regime. The Bank of Japan, BOJ, has been extraordinarily lenient on interest rates, but that era might be coming to an end as more hawkish voices gain prominence. And here's the kicker, these rates are set to rise, baby. BOJ raised its interest rates in March 2023 and again a few months later in July 2023, with more anticipated in 2024. So, if we're already at 2%, is this just the scenic viewpoint before the real climb begins? Buckle up, it sure looks that way. Now, let's zoom out a bit and talk debt, because that's really the elephant in the room, isn't it? Japan's debt has grown to over 250% of its GDP, a figure that's not just large, it's historic, actually. For comparison, most major developed economies have debt levels around the 60 to 100% mark. The US, which is another country often criticized for its excessive borrowing, has national debt at around 120% of its GDP. Japan's debt level is more than double that. The path to this debt crisis can be traced back through decades of fiscal mismanagement, coupled with demographic changes that have severely hampered Japan's ability to grow its economy. Aging population, Japan is seeing its elderly population soar, thanks to one of the world's highest life expectancies and one of the world's lowest birth rates. Japan's median age is now over 48 years old, and it is heading toward being a super-aged society where distribution of public resources, like pensions, healthcare, etc., overwhelmingly favors retirees. Translation, fewer workers, higher public expenditures. Depressed growth. Couple this demographic issue with the fact that Japan has struggled with stagnation for decades, this is often referred to as the lost decades, which began following a bubble economy collapse in the early 1990s. For almost 30 years, Japan has seen sluggish growth. This toxic combination of very weak economic growth and an aging population has put the country in an almost unsolvable fiscal mess. The essential problem being, the government continues to borrow to sustain living standards, pensions, social security, public services, without a corresponding increase in tax revenues. Japan's debt, 250% of GDP, soaring. Japan's economic growth, flatlined. Japan's population, aging rapidly and shrinking. It's a really dangerous mix when you think about it. What we're essentially seeing is Japan approaching a fiscal death spiral, where more borrowing begets more debt servicing costs, which in turn necessitates even more borrowing. The cycle is a vicious, slowly tightening noose. Let's return to that 2% interest rate hike in the broader context of financial markets. As you heard earlier, the yield on Japan's 10-year government bonds has already edged up to around 1.055%, while back in mid-January 2023, the same yield was hovering around 0.564%. Again, this might seem minor to an untrained eye, but a near doubling in yields puts heavy pressure on the Japanese government. The rise in JGBs, Japanese government bonds, yields corresponds with movements in the global bond markets, heavily influenced by what's happening in the US economy. Japan's bond market doesn't exist in a vacuum, and that's crucial to remember. As we've seen, U.S. bond yields have been increasing in correlation with expectations that the Federal Reserve would raise interest rates, and they did in 2023. New U.S. policy tools and a stronger dollar also pull up yields on Japanese bonds. As we've all seen from 2022 onward, inflation has been heating up globally, forcing many central banks, including the Fed, the Bank of England, and the ECB, to dramatically tighten monetary policies and raise rates. Though Japan, for a long while, was the outlier with an ultra-loose policy, even they have to eventually catch up. Rising bond yields are, believe it or not, great for savers but terrible for governments who need to borrow. Stronger yields mean Japan has to offer better returns to bondholders when selling new government debt. For a heavily indebted country, the math on this doesn't work well. What's fascinating is that bond yields could spike even faster if international shocks accelerate. Higher U.S. inflation or instability in other parts of the global market could push Japan's rates to adjust even higher, and the pressure will only grow. Japan's economic policy history is full of unorthodox measures. They've tried stimulus packages, massive public works programs, negative interest rates, and quantitative easing, all in hopes of reviving economic momentum which has stalled since the 1990s. But there's a deeper, long-term problem that's interwoven into Japan's economy: inflation versus growth. The Bank of Japan, BOJ, has often been battling deflation, a persistent, negative inflation rate that erodes economic growth. We're talking textbook deflationary spiral problems, where falling prices deter businesses from investing and delay consumer purchasing. After all, why buy today when you'll pay less tomorrow? This suppresses growth even as debts pile higher. And at such monstrous levels of debt, even a slowing of GDP growth means a bigger burden, a truly horrendous economic condition. Now at this point, Japan has one goal: avoid tipping back into a chronic deflationary trap. But it seems like they are walking on the knife's edge. With debt service costs rising under higher interest rates, pressure on the central bank to stave off deflation while juggling inflationary pressures, and global markets pushing up yields, there's little room left for error. The effects of weak demand, high debt, and a shrinking fiscal base are all intertwining in one tightening loop around Japan's economy. Japan isn't alone on this battlefield, it's also connected deeply to both the United States and China, two of its largest trading partners. How the U.S. economy performs, and the strength of U.S. bond yields, can have a massive ripple effect on Japan. An aggressive rate hiking cycle from the Federal Reserve could send more international investors to chase U.S. bonds with better returns, further spiking Japanese rates. Meanwhile, China presents another geopolitical and economic risk. As Japan's largest regional trading partner, any significant slowdown in Chinese activity, through economic weakness or China's own internal handling of its debt problems, may dampen demand for Japanese exports. If trade flows slow, Japan's already fragile economic growth trajectory may lose its few remaining engines. Here's the takeaway: Japan is heading into dangerous fiscal territory. Facing interest rates that are trending upward, global bond markets that are pressuring yields higher, a policy cycle that may eventually end in monetary tightening, and overall debt levels that are jaw-dropping, it's hard to overstate how unprecedented their situation is. The 2% interest rate hike by the Ministry of Finance is merely the latest sign that times are changing for Japan's economy, and not necessarily for the better. While this is just one metric in the larger economic tapestry, it shows the cracks that are beginning to form under Japan's titanic debt load. Japan's financial policy is stuck in an endless paradox: continued borrowing is unsustainable, but without borrowing, the entire economic system could topple. For professionals and enthusiasts alike, keep an eye on this situation. The next few years will be critical for Japan as it attempts to balance rising interest rates with a staggering pile of debt, an aging society, stagnant growth, and unrelenting pressures from global financial markets. Will Japan be able to manage a graceful landing? Or are we looking at the next major fiscal crisis on the global stage? Stay tuned, it's not over yet. Just remember to keep a close watch, because this fiscal house of cards is teetering.